For months, analysts have been contemplating how markets might react once we know who wins the US presidential election. As we record this on the 7th of November, we know President Trump has won, and we've had at least a day of market reaction to discuss and analyze. How have commodities reacted so far, and what might happen once we hear more from China in the days and weeks to come? Has the long-term picture for commodities changed? If yes, how? Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about this topic, this podcast is for you. I'm Mobeen Tahir, Director Macroeconomics and Thematic Research at WisdomTree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree too.
On this episode, we are joined by Judith Henke, editor in the Investment and Markets team at Handelsblatt, one of Europe's leading publications where she focuses on commodities. Very glad to have Judith on the show. But before we begin, I do need to state the following to clarify: the views and opinions expressed in this podcast are those of WisdomTree and in this episode, Judith, and are subject to change. Anything we present in this episode is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. And with that, we have a lot to unpack today, Nitesh, so I'll pass it over to you to kick us off.
Yeah, so as you mentioned in the intro, we had that big election. There was so much anticipation, so much excitement, a lot of campaigning that went into this. And I guess the polls beforehand were showing everything on a knife edge. Nobody really knew, but it's clear that the results came in quite decisively. And Trump has won the presidency for a second time. And we've seen a clear market reaction across different markets, and it's been somewhat polarized, right? Just like the American population, polarized. The equity markets seem to love the result. We've seen a very strong rally in U.S. equities. Commodity markets, not so much. We've seen we initially saw oil prices fall quite drastically. We saw gold prices fall, base metal prices fall, and all for slightly different reasons. And it's maybe worth unpacking some of that. Oil seems like a fairly obvious answer in the sense that the Trump administration is likely to be a lot more favorable to oil exploration, oil and gas exploration and production, lifting some of the bans on new oil fields that the Biden administration had put in. So that will increase oil supply. So that's a clear reason for oil prices to fall because future supply may increase. But obviously the contrast there is the oil equities. They did well, right? Because they can increase their volumes of production. So that's a clear advantage for them. Gold, a bit more complicated, I guess. The reasoning behind its movements. Gold prices fell largely on the back of bond yields rising, the dollar firming. There are clear headwinds for gold prices, and maybe some of the reasons for bond yields rising is that markets fear that the Trump administration is likely to slash taxes and government revenues, and therefore government finances will become a little bit more strained, and bond yields have risen as a result. The dollar has also firmed on the back of some of the tighter trade policies that the Trump administration or the Trump platform had advertised on its campaign. So a couple of headwinds there for gold, but um, gold initially fell and then firmed up a little bit. The question is whether geopolitical uncertainties around the world may help gold going forward, or whether continued bond and dollar headwinds continue to be factors there. Um, but great to have both of you, Mobeen and Judith, here on this call. I mean, what were your key observations from yesterday, and on this topic of increasing indebtedness that acted as a headwind for gold prices? What are your thoughts going forward?
Yeah, I think yesterday I was prepared to write like gold again, record high for the 39th time, but well, actually the opposite happened because I thought that gold would react positively to Trump winning because of his idea to impose tariffs. Because I've read a study that I think it was according to the US think tank Peterson Institute, and they said that a 10% tariff would lead to a 0.9% reduction in GDP by 2026 if other countries, of course, respond with similar tariffs. And also, since he wants to impose a tariff of 60% on Chinese imports, this would make the GDP drop by an additional 0.2% by 2026. And I thought, okay, this doesn't sound good for the economy because, I mean, economy flourishes with free trade, and I mean, also the conflict between the US and China could be, um, a problem again. So I thought maybe the investors would, buy gold, so to say, as a safe haven. But well, I think the opposite happened, maybe because of the strong dollar.
Yeah, I think that's it is a little perplexing. I think in the 2016 election, I kind of got caught on the wrong side as well. When Trump won, my expectation was that that surprise win. That at that time it was a surprise that Trump won. Um, would drive market uncertainty, and therefore gold as that defensive asset that people like to hold in times of uncertainty would rally. The opposite happened, and a narrative that I heard repeatedly after that was that there was actually gold buying by largely Republican leaning voters in the run up to that, in the fear that their worst, because their worst fears could be realized that Clinton could win. And when Trump won, they didn't feel that they needed all that gold. So some of the physical flows in gold drove that falling gold prices back in 2016. I guess this time around is a slightly different reason, but that's why I was very cautious to say that gold will rally in every scenario. I still think that gold has still got a good setup going forward, um, given that indebtedness is likely to rise, which has traditionally been a gold positive story. Right now, the immediate reaction was to spike bond yields, which is a headwind for gold, but rising indebtedness tends to drive gold prices higher. But also, there's a lot of geopolitical risks around the world that haven't been answered. I know Trump came in on his on his platform, saying that he'll be able to resolve the Ukraine Russia crisis. Yeah, in his first week, I think that's quite ambitious, right? I mean, that may or may not happen, but the continued war in Russia could keep gold prices elevated. A continued war in the Middle East is likely to keep gold elevated, and I don't think that some of these problems are that easy to resolve. Um, but also the continued monetary loosening across most of the developed world is likely to take place, and that's going to be gold price positive. We've had a number of fairly positive macro data releases in the last few weeks that indicate that the Fed may not have to keep the same pace of loosening as we may have assumed a couple of months ago. But the data is patchy, and it's not really a foregone conclusion. So I think gold could potentially have a bit more upside. And the dips that were presented yesterday could be a good a nice entry point for many investors. But one thing that fell a little bit more than gold yesterday was silver. Silver is that metal that's quite tied to gold. It has a 80% odd correlation, but it is a bit more industrial. Mobeen, I don't know if you have any views on or what's going on with industrial metals and industrially inclined precious metals.
I was very perplexed, Nitesh, looking at the initial market reaction towards the industrial metals and industrially inclined precious metals, if you like you mentioned, silver. And Judith made the observation that some of the policies, it seems like they should be positive for some of these commodities, even on the industrial front. Like if you think about what happened with equities, equities reacted very favorably to the election result on the 6th of November. If you look at, depending on which index you were looking at, equities were up somewhere between 2.5% and 3% on the day. Now, arguably, you could make the case that there is an uncertainty effect leading up to the election where markets just don't know what will happen as a result of the election. And maybe that was causing risk assets to be a bit more cautious. And once that has been removed, it has allowed equity markets to focus on the fundamentals, which, as we are in the start of November, we're in the middle of the earnings season, and earnings have been pretty strong. And maybe that's driving equities now instead of the uncertainty leading up to the election. But you would expect something similar to happen in other risk assets as well, like industrial metals, because as you observed, Nitesh, if some of the policies are for bigger tax cuts, more spending, expansionary fiscal policy from the new Trump administration, that bodes well for industrial metals in principle. So maybe that initial reaction could be corrected, and maybe we are seeing initial signs of a reversal in that initial reaction. So after a drop in industrial metals and silver and so forth, perhaps as we record this early morning on the 7th, we're seeing a slight recovery following that first reaction. So I would expect and I would hope that that continues in the upward direction. But speaking of policies going forward, Judith, I'd love to ask you, what are the big stories you think we should be focusing on with regards to policies we can expect from the new administration in the US, and how might that affect the various other commodities? You mentioned gold. Any thoughts on any other sectors?
I think what would be interesting is what will happen with the IRA. In my opinion, because some people were fearing that Trump would withdraw the IRA, and since he's maybe not so convinced about climate change, but I don't think that he will stop IRA, because many Republican states profited from this as well. But maybe in terms of some details, for instance, subsidies for electric vehicles or for some specific projects, maybe there will be like a bit of a drop in demand. But I think the bigger story in renewable energies and electric vehicles is China. So I don't think it's that important what happens. I think what would be more interesting is really how the relationship of the US will with China will develop, because China has this huge power over the supply chain of many commodities, many important commodities like copper, lithium, rare earth. So maybe there could be the risk of China imposing more export controls, as it already did in the past, and that could be also price positive for industrial metals. So I think that could be like an interesting aspect. I wouldn't say in the near term future, but it's something that will develop like with some time. So I think this is something we should look at. And also looking at oil, of course, more supply would mean lower prices, but also we should remember that the sanctions against Iran were imposed by Trump's government. So maybe now he will be more focused on imposing these sanctions, because I think the Biden's government like looked a bit away and let Iran export oil, continue doing it. So maybe this could also drive the oil price a bit higher.
Yeah. I think you hit some amazing points there. I think the tariffs are, I guess, the clear concern for a lot of the markets. 60% tariffs on China, potentially higher tariffs like on the electric vehicles. But as you rightly point out, US doesn't really import that many Chinese electric vehicles anyway, so it doesn't really. You can make it 1,000%. It probably doesn't change the level of imports that much. But I think the broader tariffs are something that China is fearing. And remember, back in 2018, when the trade war really got to its peak under the last Trump administration, um, it hurt China. It hurt China quite badly. Also Europe as well. But China is probably preparing for some repeat of this, aggressive trade reaction. Um, China could potentially retaliate with stopping importing US grains again. It's that last time with corn and wheat, or soybean in particular. But I guess its ability to do that is slightly diminished because it's importing a lot less today than it was before. So it's less of a threat to withdraw from imports. But once again, that's another class of commodities that could get hurt alongside the metals, which are obviously being hurt by this specter of higher tariffs, given how important the metal markets are for China. And as you mentioned, Judith, the embargoes on rare earths like germanium or gallium that we saw a few months ago, they could be stepped up. So that's quite a risk for the US in maintaining its um, you know chip industry, its renewable energy industry, or its energy transition. But I think that's quite an interesting point you made there, Judith. There, that the IRA probably will escape because it is largely the red states that have been benefiting from the credits and the expenditure here. But what about other climate policy? Trump's last when he was last in administration, one of his first things that he did was rip out from the Paris Agreement. Do you think that's going to happen again? And what would that mean for the broader energy transition, at least from the US?
That's a good question. I don't know. I mean, of course, it could happen again. I don't think it's like maybe his first priority right now, since of course the US has other problems right now. The economy is also a bit suffering. People are complaining about high prices, about inflation, but of course, the US have this like function of other countries are looking what the US are doing and saying, okay, they are looking about how to reduce carbon emissions, so we should do as well. So maybe if the US isn't that dedicated to do that anymore, it could demotivate other countries too. Even though, I mean, it's stupid. Every country is responsible for itself. But of course, then maybe the energy transition demand could be lower than before, and then the demand for certain critical metals could be lower than before. But on the other hand, climate change or not, I think the US will look at which energy is the cheapest and the most reliable. And so maybe if it makes sense in an economic way, there could be still a lot of renewable projects. So yeah, let's wait if there are these huge consequences.
Yeah. Well, Bean, I don't know. One of Trump's biggest donors was Elon Musk. He has a big business in electric vehicles, batteries, solar. Um, how do you think that complicates or simplifies this answer on energy transition from the new administration?
It certainly complicates it. I mean, but it's an interesting story to watch because we were speaking about China and we
Mhm.
were talking about the energy transition, electric vehicles. Now, one of the big stories I really like to follow these days is this new revolution of Chinese electric vehicles taking the world by storm.
Mm.
And that's precisely why Trump wants to, well, the US really has been imposing taxes, and Trump will probably continue doing so on tariffs rather on Chinese electric vehicles. Europe is following suit, and despite all the tariffs, European automotive industry is still facing challenges. So China has reached a stage where they've found a way to make electric vehicles so efficiently and at such a price level that despite these tariffs from the US, from Europe, they're still producing competitive vehicles and challenging some of the incumbents in the industry. So I would expect Elon Musk to be in Trump's ear and continuing to push those tariffs on Chinese imports. But I'd love to hear your perspective on what's happening in Germany, because if we've been seeing in the last few weeks news coming out of Volkswagen and them perhaps shutting down their maybe 3 plants for the first time ever in their history, and laying off part of their workforce. Now, the automotive industry is a big part of the German economy, and when we talk about the economic challenges facing the German economy and the European economy, we do talk about the automotive industry. And if China is really scaling up their presence in this industry, I think it's an important topic to talk about. So, would love to hear your take on what you're seeing in terms of European position on Chinese electric vehicles and other imports, and the broader challenges it poses to particularly German automotive industry.
Yeah, I think the Volkswagen crisis is not only connected to the Chinese boom of electric vehicles, but also I think if we look at the data of German economy, we see that we are in sort of a recession. Also, the prices are rising a lot. I can see that like on my own. If I go now to the supermarket, I would say I pay for 1 week of food, I pay like 150 or 180 euros. And I think 2 years or 3 years ago, it was more like 100 euros. So we pay a lot. So I think many Germans think twice before buying a new vehicle, especially an electric vehicle, because we all know that there's a lot of development still, and maybe that's what many people are thinking, like if I wait a few years, then I can maybe buy a better vehicle than now. So I think the will to buy new cars is not that high anymore. And also, yeah, of course, the Chinese cars are much, much cheaper. I think it also is connected to, yeah, a lot of subsidies of the Chinese government. They are putting a lot of money, not only into production, but also what is more important into commodities and cheap commodities. So I think they have, yeah, a big, yeah, they are a bit ahead of Europe in that case. Yeah, so I think it's hard to overtake China in this way. I think they should focus more on quality, on other segments of customers. And actually, I don't think this tariffs we have now, like in Europe, for Chinese cars are that beneficial, because I mean, we are all living in the like same world. So if more people are buying cheap electric cars, even though they are Chinese, still they are changing their way of movement. Yeah, driving an electric vehicle now. So like in summary, it would be better for the environment still. So I don't think it's the best way to save German car industry. It's, I think, more a symptom of the whole economic crisis we have now. And also yesterday it was a bit of a crazy day in German politics, because the government, the coalition between the Liberal, the Green, and the SPD, Social Party, so to say, they split up, or they are going to split up. So maybe in a few months we have a new election already. So yeah, and I also think this is connected to many people being not happy about the economy right now, and of course seeking the responsibility in the government, and yeah, being not happy with what they are trying to do.
Judith, your very clever pun about it being very hard to overtake China in this industry did not go unnoticed. I liked the reference there. But speaking of China, Nitesh, I want to get your take on something. We have the uh, Standing Committee of China's National People's Congress. They're meeting, and their meeting is expected to conclude on the 8th of November, which, as we record, is a day after our recording of this podcast. Now, in response to the election result in the US, uh, they may reevaluate what they want to come out with, and of course, a lot hinges on what they might offer in terms of fiscal stimulus for the Chinese economy. In recent weeks, we've heard numbers like in the order of 10 trillion yuan being mentioned in various sources. That's the scale of stimulus that we can expect, but we might not immediately get all announcements at once. Maybe it's a gradual thing. Maybe they hold some firepower for what happens further down the road. Keen to get your take on what we can expect from China in terms of this fiscal stimulus going forward.
Yeah, short answer. It's always hard to predict. Back in September, they came. The Chinese authorities, mainly the People's Bank of China, came up with a massive monetary stimulus, slashing interest rates, reserve for requirement ratios, and then gave strong hints that there'll be something similar on the fiscal front. And then we've been waiting and waiting. There were numerous opportunities for the federal government to have made some announcements. And while there's been lack of concrete information, the indication was that there's a big intent for fiscal stimulus. So the warm words have come out. Now we're waiting for some numbers, some concrete numbers, and so there's a huge amount of anticipation from this 4-day meeting, where we should get some conclusions tomorrow. Um, Obviously, it comes in the week of the U.S. presidential election, and obviously that changes the global landscape, right? The status quo of this year will change once again, um, and China will need to react to what could potentially be higher tariffs placed on the country. Um, my feel is that would require a higher dose of stimulus to keep the domestic economy going to counteract that potentially lower export volumes that will come from higher tariffs. But the key question is whether they'll announce it this week or whether they'll wait for tariffs to be announced and then announce that even higher fiscal spend. Because if they use all their dry powder up this week, what's left to come in, you know, January after the inauguration of Trump, or February, or whatever the new tariffs come into place. But from at least today's meetings, at least I think some of that firepower will be used to announce a higher fiscal spend. Because let's face it, China has been living in a protracted period of a real estate drawdown. Its equity market had, until its recent announcements, had faltered, but it needs to follow through, right? There's a big sentiment trade that the Chinese government, I think, are kind of waking up towards. It's insufficient just to use warm words. It needs to follow through with action at some point. So we are expecting at least some announcements of larger fiscal spend. Whether we get that 3 trillion plus yuan spend all in one go, hard to know. But I think some continuation of its current policy path in terms of promoting renewables, batteries, the so-called new three will still take place, even though we can see overcapacity there, overbuilding of cars and solar panels, and the global market is um, you know resistant to taking some of those with the tariffs that we just discussed. I think China will still continue to promote them because it wants that energy transition for its domestic economy. It wants to be able to move beyond um, excessive use of hydrocarbons, which is importing from the rest of the world. Now, think about the volume of oil that China imports. It's it is the largest importer of oil. Last year, it accounted for 70% of oil demand growth, but that's fallen massively to 20% this year, and I think they'll continue to fall. And we're already starting to see net declines in month on month crude imports from the US, from China. I think that's a path that is very intentional. It doesn't want to import this much oil, and it wants to be more self-reliant on energy, especially as the world's largest oil producer now is the US. And my guess is with the Trump administration, it's going to become even larger as an oil importer. So I think there's a lot of promotion, I think, towards the energy transition suite from China that we'll probably see from this fiscal package.
Speaking of oil, Nitesh, maybe that's a good topic to get our concluding comments. How does it influence what we can expect from OPEC and so forth in the coming weeks? You mentioned demand slowdown and so forth. Judith, I know you talk about oil markets and OPEC policy as well. Maybe we get a last comment from you on what you are seeing in terms of oil prices going forward, and then we get a reaction from you, Nitesh, before we close.
Yeah, as you already said, the Chinese demand was disappointing this year. And I think that's also the main reason why the whole demand expectations were corrected downwards. And on the other hand, other countries are increasing their supply, not only the US, also countries like Canada, Guyana, Brazil, I think, even Norway. So we have, yeah, supply growth and not as much demand growth as expected. And of course, that's a problem for OPEC. On the one hand, some members of OPEC are interested in a high oil price. I think the IMF says that Saudi Arabia needs an oil price at about 100 US dollar per barrel in order to not have a deficit. But on the other hand, other OPEC members just want to produce oil and earn money. So there's a conflict of interests. So last November, there was already this conflict of interests, and then 8 countries were saying, okay, we are additionally reducing our oil production. And actually, they wanted to increase it step by step starting this December. But on Sunday, they decided to postpone this until January. Let's wait and see if this is the last postponement. But on the other hand, I mean, they cannot help losing market shares to other oil producing countries that are not members of the OPEC. So I think they're coming to a point where they should decide, okay, can we afford to lose these market shares and also market power by still cutting supply, or should we really start increasing it again? So I think the OPEC meeting in December will be a very important and exciting one. Let's wait and see what they will decide. But I mean, no matter what they do, I think in 2025, the predictions of at least of the International Energy Agency, they are still thinking that there will be an oversupply, even if the 8 OPEC members will postpone supply growth even more.
Yeah, and I think the oil markets are in a bit of a a difficult place. There's so much onus right now on that OPEC restraint of more than 3 million barrels per day. OPEC can change their mind at any meeting, right? And that production restraint unwind is on the cards. They've been delaying it for a number of months. But at what point Saudi Arabia decides that it can't afford to give up any more market share is the question. Now, I've always had the view that Saudi Arabia can play the long game. If Saudi Arabia produces at current levels, it's got more than 100 years of proved reserves there. If US continues to produce at current levels, it has about 10, 15 years of proved reserves. So Saudi Arabia can wait till US exhausts its proved reserves and then pick up all the market share back again. But that is still a long period of time to wait, right? 10, 15 years. We saw Saudi Aramco's, results earlier this week, and you can see that, profitability plunged. Not only is volume falling, but the price of oil had been declining as well by 10%. So if you have that combination of weak prices and volumes being low, how long can a state oil company, maintain its resilience, especially in a nation which is very, very reliant on those oil revenues. Saudi Arabia hasn't diversified its economy enough yet to take off its its reliance on the oil industry, and social spending in that country is very, very important. So is the capital expenditure for the investment on moving its economy forward. So my guess is that at some point Saudi Arabia has to take some of the pressure off and possibly has to increase its supply as well. Um, I guess the other area in the oil industry, as Judith, you touched on earlier, is Iran. What happens if the extra territorial sanctions on Iran are imposed and enforced once again? That could take one player out, and they give more opportunity for other OPEC players, but it causes tension in the OPEC group, right? That's the key thing. That tension is always hard to resolve. But I think the way things are positioned right now is that the intent is always to increase production. It's just been delayed. So even if Iran comes off, all the other countries say, "Well, we intended to increase production anyway." That may be that way of resolving that tension in that group that meets in Vienna now and again.
So a lot to track in the world of commodities. Lots of macro drivers moving various commodity sectors. The U.S. election, the reaction from China, oil markets, OPEC, and we will keep you all posted on this podcast. But thank you everyone for tuning in. We hope you've enjoyed this episode of the Commodity Exchange. If you want to hear more from us, please do subscribe on whichever platform you're using, and please take a moment to leave us a 5-star rating. All of that engagement really does help. You can follow us on LinkedIn or X, and of course you can follow Wisdom Tree on those platforms as well. If you want to learn more about commodities, visit Wisdom Tree's website, where we have a wide range of research materials and insights. But with that, see you all next time.